Hello, folks. Welcome to the State of the Market. I'm David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. I'm going to start off with some disclosures. As always, I will share some links as well with you guys. And if you'd like to check out our ETF prospectus page as well, don't forget we do look at ETFs in this webinar. And so we are sharing a link to some prospectuses where we will show you standardized returns in a minute. Now, remember, in this webinar is something we do on Mondays. We look mostly at weekly charts of the big indexes. We'll mostly be doing that. And I think the big picture here, in my view, is that we have a breakout here of a respectable amount above the old highs that we're holding, and we're near term overbought. By the way, these are the let me actually just there we go. All right. These are the standardized returns if you want to see those. And basically, I'm going to also add a little note here about our upcoming event that I'm going to tell you guys about in 1 second. All right, so I'll just mention that first I'll just show you this chart because this daily chart of the S&P 500, get this is to me one that I kind of keep looking at. I'll just quickly tell you that I'm going to be in Miami the week before Thanksgiving at the Crossroads Summit, which TradeStation Group is sponsoring. CrossroadsSummit.com is a website. There's going to be some really interesting speakers there about changing trends in the world of business and economics, and I will be interviewing some of them. So hopefully you'll make it November 21st and 22nd. CrossroadsSummit.com is the link, and it's something we also will talk about in our market trends on Thursday. Remember, on Thursday we do market trends and we talk more about company news, we talk more about economics, and we talk more about things on daily charts. However, this time I want to just mention here the daily chart of the S&P because we look at this a lot overall. And one of the things I've talked about is the 9-day rate of change. That has been kind of leading the market by the nose. When it goes negative, it has this kind of effect of going negative and then getting more negative. But then when it starts to trend higher, we've seen this multiple times in these pullbacks. It was also the case back in the spring when we had our pullback. So, I mean, that to me is on the daily chart. I don't have this on my trading view chart that I'm mostly focused on, but the key thing is that 9-day rate of change giving us the signals here that are, kind of consistent with an uptrend. But the other thing, and I'm a believer in this, is the RSI on the daily chart as a trend signal. We've talked about it a lot, done some different kinds of things about it. And I find it really interesting to notice that if you look at historically when the market is in a smooth uptrend, you will see RSI go overbought repeatedly and never go oversold. I call this RSI cooking when it just kind of goes up to 70, 75 and just kind of simmers there. And that's kind of what, we might be kind of setting up for here potentially. I think it's just interesting to realize is that, we had this pullback and just there's nothing here that really kind of gives a sense of any kind of bearish sort of conditions when you look at this. This is just everything. Most of these things I can see here when I look at them are consistent with that kind of steady uptrend of money melting into the market. On other charts, you can also see that like the 5-day moving average is above the 20-day moving average, and the 20 days above the 50-day, the 50 days above the 100-day. All those are consistent with an uptrend. We have this high or low here with this high here. There's a bullish triangle breakout. When you look at it. So I think this is all just kind of in my view here, kind of some daily signals to tell us what we want to see. So anyway, I'm going to now go to the main things on trading view. Wait a second, let me close this. Anyway, so now we start just working down our list. We look at the daily charts of these big indexes, and so what is interesting to me here is we start with the Dow, and we basically cleared above 42,000. Actually, before I go on anymore, I want to just mention I have a concept that I've discussed at different times, which I call the market going through volatility cycles. And when the volatility goes down a lot, you enter more of a stock picker's market, and in my view, that is something now that we have essentially entered. We're in a spot now where the indexes are making smaller correlated moves. Stocks are making smaller correlated moves in terms of correlation to the indexes, and there's more there's just more individual stock picking. So this is sort of environment now where we have exited the correlated move, and we've entered the phase of small moves for the indexes and individual stocks making interesting moves. And so correlation is going to matter less, and to a certain extent, indexes are going to matter less. Individual stocks will matter more. It's this kind of like cycle I often talk about, the volatility cycle. We've talked about it different times in market trends. All right, so the Dow, though, clearing 42,000. And if you look at it, it's pretty interesting to see how last week it cleared this resistance level. And so from my perspective here, this is something where when you look at this, there's no real kind of signal, or there's no reflection of anything particularly suggesting to the downside. It's cleared this kind of resistance, and it's a relatively recent or new breakout. And this could be something now where people just looking for overall momentum and respecting the trend, think that this could extend further before it has much of downside. What has been most interesting has been the kind of weakness in the cues relative to everything else. And one of the things that I've been seeing now is I have actually been seeing a little bit more sign that the money is going back to the mega cap growth stocks. So actually, go back over to our TradeStation, and we go to this, and I go to this radar screen, and I go to my key ETFs. Look at the 10-day return for the key sectors of the key spider funds. Technology is leading, then consumer discretionary, then communications. XLK, XLY, XLC. Now, they don't necessarily all have in terms of the way the individual charts are behaving, are not necessarily all equally having equal signals. But if you look at the price performance, it's interesting to me to see them starting to move in concert. At the same time, when you look down here at the indexes, you can see that who's red today? The Russell. Who's starting to lag after a period of outperformance? The Russell. The Russell was leading in the last month. Now, kind of today it's red. It's also, just kind of, it's starting to, it's in the last week, it's outperforming the S&P, but I think we have to just also, be aware that this thing tends to go in these periods when the Russell rips and then it just peters out and money goes back to the mega caps. So I think, that's something we have to be on guard of here, potentially happening. When I look at it, it was very interesting last week, and I'm going to get to this, but to see the way the financials did not break out, materials did not break out, but the communications did. And we were talking about 88 on the XLC. On the XLY, this is when we've been really kind of emphasizing this, these levels. It just tore right through. We were talking about 188, and it just destroyed that level. Now it's coming back, and it's just taking out the July level. And what's interesting is that you have a level up here all the way back from November of 2021. So this is XLY. I should have gone in order. I'm sorry. The key thing is, this is the one that, to me, that is kind of grabbing the most attention right now. We have Tesla in there, we have Amazon in there, and then we have all these other retailers going toward the holiday season. We have home builders in there. We have things like Expedia in there and cruise ships in there. All these kind of companies that, so it's not just big cap, but it also kind of fits that. So to me, this is something that is, very kind of meaningful here to take a look at what's happening in XLY. And, to me, this is maybe the most important sector right now to be looking at, XLY. And it's one of the three mega cap sectors: consumer discretionary, communications, and tech. Those three, you will notice that they tend to move like a mega cap market. Those three outperform. Then when you enter the other kind of market like we had recently, then they actually lag. So, we recently had a market when utilities were going up and consumer staples were going up and tech was weak. That phase might have been ending, and that's kind of what I wanted to mention. So anyway, that to me is important here. So we look at the cues here, and I got to say it's interesting because you have this resistance level back here, really this high from kind of mid to late July, and you can see how we had this kind of resistance level, and I think it held this support, and now I think we have this very tight level here. So on one hand, you can say that this is hitting resistance and it hasn't broken out, but at the same time, if the overall market remains in this kind of breakout situation, and then you look at some of the things coming up this week, Meta has a big event on Wednesday. Nvidia has at some point, this new chip coming out, and the thing with Apple and the new iPhone. Um, all these things are kind of out there. And the question is, does the Nasdaq just roll over and die here, or does, with the broader market in an overall bullish situation, do we see the S&P remain above 5,700? Do we see the small caps weaken? Do we see financials stall? And do we see money go back to tech? And that might be more the kind of logic we have here. So even though we don't have it necessarily on the chart, what we do have here is we basically have holding a tight support. It did not retrace 50%, don't forget, of this move. It went nowhere close to retracing 50%. It surged and it held real tight, and then it pushed to a new high, and now it's pushing against intermediate term resistance. So from my view here, I think when we look at the Qs, this might actually be more a question of the strength returning to the Qs. So I'm kind of watching to see if we can get above this kind of 484.5 area on the Qs. The Russell, on the other hand, is kind of just the opposite. It's interesting how it's basically, you know, just kind of trapped now. And when I look at this, this is to me a very kind of sloppy sort of condition. I did not like the way the Q that this. I did not like the way the Russell broke. It violated the 50% retracement. That was not cool. If you're a bull, I got to say, when you look at this right here, it just totally crushed. It just blew right through it, and now it's failing to break out through its high from August. Look at the Qs in contrast. The Qs, even though they were more painful in a way, they behaved better because they more or less held that 50%. Where is it? You know what? Where is it? I mean, they bounced much more close. You know what? I'm sorry. I know the S&P held the 50%. But the thing is that the Russell, the bigger concern for me on the Russell is the fact that it really retraced more than half of its, not the IW, look at RUT, that's what we're using. The Russell really violated that 50% retracement. Now it's stuck back at this level. So I think here we have to realize that there has been a pattern of people just abandoning the Russell and then it basically just languishing. And I think with all this space here back down toward 2000 or 2040 on the Russell here, there could be a risk here of money going back to the large caps and this thing just entering another long period of purgatory. So that's kind of what I'm looking at here on this one. And I think also there is a risk of some kind of channel of some kind of thing like this happening. I mean, I'm not going to say that that's exactly the pattern, but something along those lines, some kind of filling and consolidation at this moment. And it could simply be a question of the fact that the large caps have at this point, that favorability potentially into year end. So if for me, if the Russell manages to close back above, especially, I think at this point we have to really say it needs to close above its high from the summer. It needs to take out kind of 2261. A close above that closing high would be kind of putting us more on track to have a confirmation of some kind of breakout. But the fact that the S&P has broken out to new highs, the Dow has broken out to new highs, and the Russell is below its summer high, that's not necessarily a good signal. And any kind of weakness in the market, this could be the one that takes the first hit on the selling. So the S&P, like we've mentioned, it's holding above that old high. And when you look at it, it's about, I guess at this point, it's essentially about 1%, above its old high. And it hasn't had any kind of real pullback yet. So at this point, people can view this as more or less a confirmed breakout. Here we are, the third day into it, and so I'm just kind of watching this here. I think that the lack of selling speaks volume at this point in time. I think there is, when you really look at it, this environment here, double-digit earnings growth starting in the fourth quarter, the Fed being more aggressive, and then again, I think the absolute carnage in crude oil just continues to be something when you look out into the future of the potential of a Goldilocks environment of strengthened domestic economy, lower inflation, and Fed rate cuts. Those things all go together. Huge amount of cash on the sideline and the potential of a sentiment shift because, like as I said, people remain highly negative when you consider the unemployment situation. We have basically levels of sentiment now like we had in the early 80s when inflation was 9% and unemployment was over 6%. Or maybe it's the other way around. I can't remember. But anyway, in the early 80s. I did a video on this a while back, and unemployment and inflation were much higher than they are now, and consumer sentiment was very similar. So, if you look where we are now in consumer sentiment, a lot of sentiment gauges, we are much lower than we were like pre-COVID or back in 2007 when the economic numbers were not nearly as good. So, anyway, that is the S&P more or less confirmed above the old highs. The treasuries we had said kind of had a chance of flicking up and testing some of these levels. Jerome Powell speaks on Thursday. Then we're going to have payrolls the following week. In my view here, again, the treasuries have kind of done their thing for now. And, there is, in my view, some potential here of, it might not be super prudent to just expect we're going to stay below that December low. At this point in time, yeah, we broke under it, and now we can say we did it. But it often can be more wise to look to recent levels. And so I think right now when we look at the 10-year, we might want to be looking closer up here to 390. Really, that might be the kind of area that becomes the place that we might want to test up toward. So at this point in time, the upward trajectory in yields not significant, but the idea that yields just keep plunging lower might not really be in the cards. It might be more a case of some consolidation, some upward drift in treasury yields for a few weeks. Maybe we need to get by the Powell event. The Powell event is the next likely event on Thursday, but then the real likely event could be payrolls the following week. So I think right now, that's kind of more of my kind of as I look at the calendar and the sort of things that might happen with the treasury yields. So this recent bounce might have a little bit more happening in it. Um, in no way, though, does this argue that we're going to see any significant reversal. It doesn't seem to have that. All right, so the materials we talked about, and to me, this is one that I this looks something that I've said has this kind of you know brewing potential for some kind of an interesting breakout and rally. And I think we do want to watch to see if we can close above. I mean, last week we had a rejection here, and this could be with the Fed being dovish and everything else. For me, the materials. I mean, nobody talks about it, but some of these are stocks that don't forget the material stocks are chemical companies and packaging companies, and they also have companies that do things like provide gravel and crazy stuff like that. But at the end of the day, there's only a few that really have that direct China exposure the way they used to. So with the Fed cutting rates and the U.S. economy strong and things like that, this is one that to me remains on breakout watch. And it's last week it failed, but it's not backing down. So this might be one that we want to just kind of keep our eye on to see if this can accelerate. When you consider this kind of basing pattern all year, this this is the kind of thing sometimes you look at, and sometimes charts like this, when they have this high basing pattern and they break out, you get a pretty significant and sustained run. So I want to just kind of point that out in the materials, XLB. XLC, we've been really talking about not exactly 88, 87 and three quarters on this one. And basically, we squeeze above it, we're holding above it. Meta has this event coming up. And so at this point, this name is I mean, this index, it's also broken out to new all-time highs. This is one here where it has given some confirmation that it has broken out. And I think we have to realize, with this close above the old high, this might be something people look for some acceleration. And remember, one of the patterns we look for is a new closing high on the weekly chart, and then often a little bit of weakness, a couple of days of weakness, and then potential continuation. So that might be something that we're looking for in communications. Energy, on the other hand, remains just, weak overall. Here it is. I mean, this is the one that has the most kind of, it's the worst performer this year. It's the one that we have been most kind of wary of on the weekly chart, noticing the consistent pattern of lower weekly highs and lower weekly lows. We actually just did a trading view idea on Chevron, which is, I think, number 2 in the XLE. And I mean, you can check this out if you want, but basically, it has a lot of things here that people might consider potentially not bullish. And so anyway, here we are kind of testing up around 90, but failing, and something people just might want to keep an eye on. Of course, we still have the situation happening in the Middle East with Israel and Lebanon right now, attacking each other. However, the situation is what happens if it ends? What happens to oil then? And I think that might be more the kind of view of once that fighting, I mean, if it does, who knows? I mean, I'm not going to try and predict geopolitics, but I just look at the catalyst at work now, and it might just turn into a sell the news thing, where basically or people, right now it's being propped up by this news event, but if the news event goes away, then we go back to fundamentals, and the fundamentals are lots of oil and not the greatest demand scenario. So energy here remains something where the downtrend seems to remain intact. um, and so XLF, this was to me something that I really didn't like, this candle on the bull side back here. And we did kind of test back up, but we were unable to break out last week. And I think when you consider the fact that the S&P broke out, and then you consider the fact that the financials did not, that is also somewhat of a problem potentially. And so it's interesting to watch this strength we've seen in financials recently. And then essentially this was happening at a time of weakness in mega caps. So I think we have to also realize here, this might be something where if we see rotation back to Nvidia, back to the big cap tech, back to the Nasdaq, and the XLF has not broken out, this could be something where we basically enter a range between 43 and a half and 46. And so I think this is something we have to kind of be aware of. I'm watching XLF here, and the failure to break out, in my view, is something that might trigger some lack of enthusiasm. Now, industrials, on the other hand, had a confirmed breakout to an all-time high. They're staying strong, and I think this is another area here. We've talked about this, how it held 126. That used to be resistance. It became support, had a brief period of consolidation, and here we go. So at this point, this is, something people might view as a confirmed breakout in the industrials. Now, remember, we did do this we did do on Caterpillar a trading view idea as well. Cat, and this is one that this is the daily chart, but we had this level, we really were talking about this old high from back here in July that we're now closing above. So Caterpillar here was just kind of an example. It's just, we're talking about stock picking. This is when it just popped up. I'm not going to get into that too much, but anyway, the industrials here, something of a confirmed breakout. Now, XLK looks very similar, not surprisingly, to the Qs. Again, though, I mean, this is something where, yes, you can argue that there's bearishness in this. It's failed to break out. And all those things are true. However, again, with the S&P at all time, kind of near those highs, and a calendar in front of us that, if you look at it, unless something gets out of hand geopolitically, it's hard to see something that here becomes any kind of clear problem, or any kind of clear bearish catalyst, as long as the S&P stays above 5,700. So the question is, does this kind of actually turn into a positive drag on XLK? So for me right here, I think we want to be kind of watching these levels all the way up, more or less, to this level in late July, which in this case is 227-ish. We had these recent highs, and they're all relatively close together here. So something people might kind of see happen is just kind of, it can't go down. There's money on the sidelines, and then it just oozes in and oozes in, and before you know it, it starts moving higher, and then it starts to kind of accelerate. And that might be the environment we're in right now. So from my perspective, that's kind of what we want to be watching. And we have last week's low, I think, is also something to kind of sanity check that, as a, as, if it doesn't, if it goes below that, then it would actually say maybe that's not, maybe things are not going to be, a melt up. But in this case, holding these levels so tight, given the events coming up, it might be more of a pull from the broader market. Now, the consumer staples XLP. This is a first bearish week for a while. It has broken out. However, again, this is kind of like the something that goes up when the market is not doing as well. So, if we have, excuse me, if we see a period of return to the mega caps, return to the Nasdaq, this could enter a period of sideways movement. It would not be a huge surprise if that were to happen. So I think we have to realize that consumer, staples, they're kind of fun for a while, but we are talking about companies like Coca-Cola and things. We're not talking about, like, fast growing tech stocks. So, I think right here, This has had an interesting run. We had a lot of confirmation candles here and stuff, but there's also signs here of this kind of stalling out. And this level here around 82 is the first one that springs to mind. But you can see down, kind of all the way down to 81, down to 80, kind of all the way down, kind of 81, the old April high. All that, could see some consolidation and filling in here. So this was a fun little run. I mean, if people like consumer staples, it's something most people probably don't pay much attention to. But this is also a counter. This is kind of a bear market rally or a kind of safe haven rally when the mega caps were struggling. And now, if there is a return to the Nasdaq, this is something like I said might have a period of consolidation. So just kind of bear that in mind. Now, real estate is kind of holding here, and this has not yet gotten up that. I mean, this is actually of all the sectors, this is the worst relative to its all-time high. Its all-time high was back here in April of 2022. It's still far below that. So, this is now had its first red week in a while, but I mean, the thing with this thing has been higher weekly lows pretty much ever since the end of the second quarter. Like every single week has had a higher low. And so right here, we're making an inside week, which means you have a higher low. So let's kind of see here, but this might be something where a higher weekly low confirms that this uptrend remains in effect. We have this high from back here in August of 2022. We have other highs up here. Idea of a Fed, cutting cycle in front of us. All those things would be kind of supportive potentially of real estate here. Some weakness, like I mentioned, there might be some upward squeezes in treasury yields, might not be terrific for XLRE in the near term, but let's just kind of see if it can form another higher weekly low. And if it forms an inside week, that would also be a potential kind of continuation pattern, just some kind of consolidation. While the near term overbought, if you look on the daily chart of XLRE, this is something here where we jump over to our daily chart. You can kind of see this is a 10-day moving average of the 50-day. It was overbought on RSI. MACD here kind of crossing lower. So this is something where things like this, the MACD crossing lower when something is in an uptrend, you'll often see that, and then it'll just pause for a short time and then have continuation. So this here, looks like a potential kind of short-term, pause and consolidation period here. I mean, it's down what 2, 3, 4, 5 straight days. The question is, 5, 6. How many days can it just go down consecutively? It could be one of these things when it falls, consistently, but barely falls at all. And then suddenly people come back to it. And I think that's kind of what we're seeing here. So this is overall not necessarily a very bearish pullback. All right. Healthcare, I'm sorry, utilities, XLU. I mean, this thing that came out with Constellation last week kind of changed the narrative in this. However, for me, I think it kind of was also a news event that stuns people when Constellation reopens 3 Mile Island and this nuclear stuff goes, all this nuclear power for AI plants and stuff. And that's interesting. And it's this kind of news event, but it might actually mark that kind of sentiment froth that people want to sell. Again, if we go back to the NASDAQ, if we go back to the large caps, do we stay in utilities? Utilities, consumer staples, they're kind of similar. And the point here is this thing above these old highs, people might look for some pausing and consolidation, maybe a retest towards 78. So here, yeah, we have this breakout. However, this is something where a lot of news is now priced in. And if we end up with a little bit of upside in treasury yields or things like that, something like utilities here, people might want to look for something of a pause. So let's just kind of realize that this is run pretty aggressively for a pretty slow moving sector. Healthcare, similar. I mean, this is now forming what is potentially much more of a stalling consolidation pattern. And this might be something here, given the potential for, risk on and things like that, to just kind of, stall out here. When you look at it, classical technical analysis would say that this bearish outside week was not confirmed. You're supposed to close below it. I don't really always know if that's the right way to view things like outside candles. For me, the bigger point is it confirmed that the uptrend stopped. Look at this, we've stayed below it. So this is kind of showing here that something that was bullish is now essentially neutral with the potential to maybe kind of move sideways. And when things enter this period, often we get a dive, a good puke down, and then buyers come out. So this might be something where people want to see more of a test down toward kind of 151 on this, under this 152, back under this level from back here in early September. And then maybe there'll be some buyers coming off the sidelines. Now, I mentioned consumer discretion, as we mentioned. This is the one that kind of had the most kind of space to the upside. It's matched what we've been saying. We were talking about this back down here. We were talking about this potential for breakout through 188, and it has just kind of expanded. So this is the one to me that kind of continues to kind of have the most interest, because in some ways it had the biggest pullback and it had this widening sort of swings, which is real interesting swings of volatility, which kind of showed that there was negativity in this, and then the negativity, the bears just got basically crushed, and there's just none left. And I think that's kind of what you're seeing now with Tesla and this whole robotaxi event coming up. Remember the robotaxi event expected for October? Tesla also announces deliveries in early October. They don't announce the date they're going to do it, but it's usually the first day or two of October, of the quarter. So those things are out there right now on consumer discretionaries. So those are the main things I wanted to kind of talk about. I had one other like chart that I'd kind of created. I'll just show you really. It's this thing I did on TradingView, because it allows you to wait a second. This what this chart shows is it shows basically I look at the S&P 500 and down I'm doing a relative strength against the XLK, XLY, and XLC. So we're basically seeing what happens to the S&P 500 when it outperforms the mega caps. So when it starts outperforming the mega caps, that's actually bearish. When the mega caps, when this is up, it means that the S&P is outperforming the mega caps. It actually precedes weakness. But now when the S&P lags the mega caps, like down here, big underperformance, it was the beginning of the bull run back last November. So this is telling us, is this like the opposite of advanced decline line? It basically tells us that when breadth weakens or narrows, that the market goes up. So I mean, there you go. I'm just saying this is essentially it looks at the 10-day relative strength of the S&P 500 against the XLK, XLY, XLC, which are the mega cap ETFs. And like I said, when this is higher, it means that the S&P is outperforming those, which is actually a sign that the leaders of the market are faltering. And you'll see each time the market basically outperforms against those, it's followed by weakness. And when the market lags the mega caps, the overall S&P, for the most part, it has been a sign of strength. So that's just something I'm going to just kind of show you. So I think right now the big question is, are we in a period now where we essentially have a rotation back to NVIDIA, back to Meta, back to Microsoft, back to Apple? That's, I think, the question before us. However, throw in, a little bit of industrials, throw in something like the industrials breaking out to new highs, and kind of keep an eye on the material. So that's what we have for now. Remember, we will be back for market trends on Thursday afternoon at 2 p.m. Go to tradestation.com for more, and I look forward to seeing you guys again soon. Thank you very much.